Hey friends, in the video today I'm excited to share how I'm personally evolving as a dividend stock investor. When most of us start out in our dividend stock investing journeys, we fall into this first bucket or first persona of dividend stock investors. This is the rapid accumulation phase shown at the top of the whiteboard today. In the rapid accumulation phase, most of us are working active income jobs. We're grinding it out, oftentimes in a very difficult setting, to earn active income that can be deployed into dividend stocks to help generate passive income. And so this type of investor, this first persona, oftentimes is working so hard and really focused on just generating that active income that there's not as much time oftentimes to strategically analyze specific stocks or strategically analyze the bigger picture. Oftentimes, it's very difficult during this phase of the journey to take a step back and think strategically. Nonetheless, it's really exciting because oftentimes the investor starts seeing the snowball working. That investor is putting money to work. That money is generating dividends. The dividends are being reinvested to purchase more shares of dividend-paying stocks. Oftentimes, the investor in this first bucket is going out and buying these dividend growth stocks that are growing the dividends really quickly, like the Home Depot or Starbucks. These are two positions I own that are both growing the dividend in excess of 10% per year on average. Sometimes in this first investing persona, the investor might accumulate too many different stocks because it's so tempting when one is working an active income job and sees a really compelling stock just to buy it. And so oftentimes investors in this category can become collectors of dividend stocks. But what's also great about being in this first bucket is mistakes are okay when the portfolio is smaller, the investor is newer to the game. Oftentimes, mistakes can be corrected. It's possible to move past mistakes. And oftentimes, investors in this particular bucket can be patient. They don't have to see the immediate returns because they know that they have 1 decade or more ahead of them. But at a certain point, this rapid accumulation phase ends. Oftentimes what happens with dividend stock investors is they're going to hit a brick wall. That's what's illustrated here in red. The investor literally hits a brick wall and decides one night, hey, things have to change. It's time to reach fire or semi-fire. And oftentimes that brick wall, it's hit unexpectedly. It's hit at a time where maybe the investor doesn't feel like he or she has actually accumulated enough assets for full fire. But nonetheless, there's a voice inside of the investor that says, hey, we're hitting the brick wall. It's time to move on to a new phase of the investing journey. And so the second phase of the dividend investing journey is this optimization phase. This is a phase where, hey, the investor is scaling back hours at work. The investor is scaling back his or her resources that are spent grueling it out, grinding it out for active income. The investor wants to live a more balanced life and enjoy FIRE, financial independence, retire early. Now, I use that phrase loosely here because FIRE means different things to different people. Some people look at FIRE as complete financial freedom, never working another minute. Others simply look at it as, hey, I want to switch jobs and take a job that's more fun, but it might not pay as much. Or, hey, I want to work fewer hours at work so I can spend more time training for that marathon or working on a side hustle or side hobby. But that investor knows, hey, income is going to go down, so I need to use dividends to supplement the lower income. The one thing that unites all investors in this optimization phase, this second bucket of the journey, I would say, is happiness in life goes up. It's time to enjoy the rewards, enjoy the harvest from the crops. These trees, these seeds that were planted all these years ago in this rapid accumulation phase, now it's time to tap into these dividends. And so investors in this bucket are not deploying as much money into the portfolio. Investors in this phase are not necessarily reinvesting dividends. Rather, dividend income is being pulled from the portfolio to help pay for living expenses. And so this is the phase of the journey that I'm starting to embark upon. It's really exciting. I'm not necessarily saying it's a flip a switch kind of thing, but I am moving from phase 1 to phase 2. And really, I'm not necessarily changing what I'm doing with work, but more so I'm trying to enjoy life more, travel more, and enjoy a lot more leisure time with the family, which is expensive, hence pulling dividends from the portfolio. But investors in this optimization phase, oftentimes they take a step back and start looking at the portfolio holistically, because when net new income is not going into the portfolio is less forgiving. A loser will stand out more. A low yielder will stand out more. And oftentimes investors in this phase of the journey, they're looking not just to keep all of the stocks necessarily, but to move money around, to reshuffle the deck, to optimize the portfolio so that it can be the best it can be. You might remember my friend Greg, who was here on my channel. I interviewed him a while ago. I'll link to those interviews in the pinned comment before. I believe he's really an optimizer at this point because he's living the FIRE dream, but I see him reshuffling his deck from time to time. I see him moving money, selling positions, taking on new positions to better optimize his portfolio. Oftentimes, investors who are in the optimization phase, they're taking positions in the portfolio that just might not make as much sense anymore, or maybe never made sense, but because the investor has a little more time, a little more brain power, a little bit more of an ability to take a step back, the investor can look strategically at the portfolio and make really great decisions to optimize current income as best as it possibly can be. Now, what happens with dividend stock investing is there's really 3 types of dividend stocks. So I talked about the 2 phases of the journey, and I think all of us at a certain point hit this brick wall. Certainly, I feel like I'm starting to hit it. I'm moving from phase 1 to phase 2. But there's 3 types of assets that kind of spill over across these 2 phases. First, there's dividend growth stocks, evergreen quality, high quality dividend growth stocks. And the perfect example of that would be like a Johnson & Johnson, a PepsiCo, a McDonald's. And those types of dividend growth stocks, typically they serve investors really well in the first phase of the journey and the second, especially if the dividend investor has been at the game long enough. Yield on cost on those types of dividend growth stocks, it's so high, it's so great, and especially if the investor is working with a taxable account, oftentimes those stocks, they just kind of live on forever. I classify those in bucket A. You can see that over here. And that's why bucket A moves from phase 1 to phase 2 of the journey. But bucket B, these are high yielders. I would classify these stocks, a good example would be Altria. I actually added shares of Altria today. I share my stock trades over on Patreon, by the way. I'll link to that in the pinned comment below. There are quality, high-yielding stocks that make sense in phase 1 of the journey, and of course they make sense in phase 2, because phase 2, the optimization phase, it's all about current yield. It's about harvesting the yield from the portfolio. And so that is stock classification A. I've got the dividend growth stocks, I got the quality high yielders, but there's a type of stock that is falling into bucket 3, and these are really the losers. It's really when the investor hits that brick wall, starts scaling back hours, but thinking more strategically about the portfolio, thinking more strategically about optimizing, that the investor realizes, hey, I've got some losers in this portfolio. I've collected too many stocks. I've got some stocks that may not belong in the portfolio, and maybe they're not even losers, but they're just misaligned with my mission. Example for me is I own a few stocks in the portfolio that pay no dividend. Do they really serve a purpose in my portfolio? This becomes so much more evident when the investor reaches the optimization phase, because remember, in the optimization phase, the investor doesn't have a ton of money coming in that is being net new deployed into the portfolio. The investor is working with the portfolio that exists. And so when the investor is looking at the portfolio and trying to find money that can be used to generate even more yield, the first things that stand out oftentimes are either these losers or these stocks that were bought kind of for fun, but don't pay much dividends or any dividends at all. And oftentimes those are opportunities that can be found in the portfolio sold and redeployed into other stocks to immediately generate income. And so that's how things evolve in this optimization phase, which is really the phase I'm starting to enter as an investor myself right now. Now, I want to share some of the pros and cons as well of these two phases of the investing journey. Both of them are great. I have lived the first phase. I'm starting to embark on the journey in the second phase, and I want to share some pros and cons about why both of them are good and bad in their own way. So first, I want to share some of the pros of this rapid growth phase. As you can see on the screen in front of you right now, the pros are plentiful. It's generally okay to make mistakes because the investor is new to investing, because the investor is deploying new capital to the portfolio. New capital can solve a lot of mistakes. It's easy to buy a bad stock and lose money on the stock, to misjudge a stock, to make a mistake, and just kind of fix it by deploying more money into the portfolio. Also, it's really easy to change direction. If an investor was going in one direction, but it's not working that well, when net new capital is being added, again, net new capital, it can really solve a lot of mistakes. Net new capital can right a lot of wrongs in the portfolio. And that's one of my favorite things about the rapid accumulation phase of the investing journey. But that very pro, that very benefit, it's also a negative in some ways in that the investor may not make the wisest decisions all the time, especially an investor who is grinding it out, who is working really hard, who doesn't have quite as much time to think a step back, to take a step back. And so that same thing that is a pro can also be a con. But I want to share a few more cons of the accumulation phase. So check it out on the screen right now. What I also want to share in terms of the pitfalls of the rapid accumulation phase is the portfolio. It can become a little messy, too many positions. Some of you probably have noticed my portfolio. Is it too messy? I've got 50 positions. I honestly think it might be a little messy. I've been thinking about trimming back some positions and reshuffling the deck, so to speak. I would say the investor in this phase is so stressed out oftentimes at work that maybe the investor will allocate money to suboptimal positions, or even positions that are optimal but at suboptimal prices. Oftentimes the investor hangs on or tends to hang on to losing stocks just because there's so many years ahead into the journey that the investor thinks, hey, the time alone will right the wrongs. The time will fix everything. And oftentimes it does, but sometimes it doesn't. And sometimes I would say the biggest pitfall of the rapid accumulation phase is the investor believes that it will last a lot longer than it really does. The investor can sometimes think, hey, I'm going to keep going on like this forever. I'm going to keep doing this. I'm going to keep grinding it out for more and more and more decades. But you know what? I would say this brick wall, it hits all of us differently and in different ways. The way it's really hitting me right now, personally speaking, is I want to spend more time living the good life. I want to spend more time traveling. I want to spend more time with family. I want to spend more time enjoying leisure. I want to spend more time exercising. I want to spend more time cooking, just learning how to do fun things. I don't even know how to cook. I want to take on new hobbies. And so this brick wall, it hits all of us, and it hits all of us oftentimes unexpectedly. And that's why I think it's so important in the rapid accumulation phase to hustle, to grind it out, to go hard, because you never know. You can kind of forecast, but at a certain point, there's going to be a voice in your mind that says, you know what, you planned on doing this another 5 years, but no, you need to retire tomorrow. That's how it is oftentimes. And I would say that's a pitfall because I think so many of us underestimate really how long we want to grind it out and how many years it makes sense to grind it out, because at a certain point it's time, enough is enough, and it's time to really enjoy the fruit that comes from this dividend tree. But I want to keep going. I want to share some of the pros and cons of the optimization phase. Now, I'm no expert on the optimization phase. There's people here who know more about it than me, who have been at it longer than me. If you have, put in the comments below. But I want to share a few thoughts I have about it right now. So I want to start with the pros and then I'll get into the cons as well. So check it out on the screen in front of you right now. I would say the pros with the optimization phase, the benefits, is the portfolio gets cleaned up. A portfolio is kind of messy. It's kind of like a house. When you're working really hard, you're grinding it out, you're not yet retired, your house can get kind of messy, but when you have more time on your hand, probably one of the first things that all of us do when we reach FIRE is to clean up the house, make sure it's nice, make sure it's a great environment. Same thing goes for the portfolio. It's time to clean it up. Another benefit of this is we oftentimes do more with less. We have to get leverage. We look at our portfolio and we look at those stocks that are either losers or not quite carrying their weight. Maybe they're paying no dividend, and we look, how can we take that same position and do more with it, get more leverage for the same money, get more income for the same money. Another benefit is it's just another chapter of life. What's so fun about this optimization phase is I've kind of presented this red brick wall is a bad thing, but it's not necessarily a bad thing. I think oftentimes our intuition tells us to make a change in life. Our intuition tells us, hey, it's time for this next chapter for a reason, and it's actually a good thing. It's a good thing because this is when we can start really living. This is when we can enjoy all of the hard work, and this is when life gets really fun. Now, I would say that sometimes if this brick wall gets hit and we kind of realize, uh-oh, it's time to reach this new phase of the journey faster than it makes sense, well, FIRE might not look how we originally envisioned it. FIRE might be a little bit more different. It might be more of a semi-FIRE, but a semi-FIRE is still FIRE and it can still be really fun. And that's how I'm looking at things. I'm looking at things more holistically. And of course, I keep working and enjoying work, but I want to layer in more fun into life. There are so many benefits of this optimization phase, but what I also want to share are some of the pitfalls and mistakes that investors might make during this optimization phase. And so as you can see on the screen in front of you right now, I think one of the biggest mistakes or pitfalls of the optimization phase is just that mistakes can be costly. There's no net new capital going into the portfolio, or very minimal net new capital, less net new capital. And so mistakes, if one is made, can be costly. The net new capital in that first phase, boy, it corrected a lot of wrongs. It righted a lot of wrongs, but that net new capital is not there anymore. I would say the pitfalls of the optimization phase is the investor might be prone to yield traps. An investor who is optimizing his or her portfolio might be tempted to sell some of these golden goose dividend growth stocks like Johnson & Johnson with a really high yield on cost to redeploy the money into a higher yielder. But oftentimes that investor might make a mistake, might get too much focused on the high yielders, might buy yield traps, if you will. And so that's a potential pitfall of the optimization phase. As you can see on the screen in front of you right now. Also, I would say that the brick wall, sometimes it might be hit before the investor really has enough resources to sustain FIRE. And I would say in that case, if that is the case, it's important for the investor to look at semi-FIRE or just a new career, a new job. Maybe the job doesn't even pay as much, but a little less grind, a little more fun out of life. And so those are really the two personas, the two types of dividend investors. I think anyone who is a dividend investor ends up being both of these dividend investors. For most of my career, I've been in phase one. Now I'm moving to phase two. And I did present this as a brick wall where it's kind of goes from phase one to phase two. But I would also say it can be a gradual change. The investor might be a blend of type 1 and type 2 for a while before becoming full-on type 2. That's probably where I am right now. I've kind of starting to hit the brick wall, but at the same point, am I just going to flip the switch? Probably not. But for others, they have flipped the switch. I've seen it here in this community. So put in the comments below, please. Are you in this growth, rapid accumulation phase of your dividend journey? Or are you in this optimization phase, enjoying the portfolio you have and living the good life? Whatever the good life means to you. And also in the comments, put below, what does the good life mean to you? Does it mean pursuing your hobbies? Does it mean complete FIRE? Does it mean taking a lower paid job to enjoy what you're doing more? Does it mean working partial hours, part-time instead of full-time? Put in the comments below. Before I go today, in terms of a full disclosure, I do own the stocks mentioned today. I am long the Home Depot, ticker HD, Starbucks, SBUX. I'm long Johnson & Johnson, J&J. I'm long PepsiCo, PEP. I'm long McDonald's, MCD. I'm also long 3M, ticker MMM. That stock, quite frankly, would fall into bucket C. It is a loser stock, and I start wondering, where does it belong in the portfolio as I head into this optimization phase? That will be a topic for another day, but for now, my intuition tells me to hold on to this stock for my own personal situation, while probably continuing to reinvest dividends at these contrarian kind of bargain basement levels. This all ties into my last video about sentiment. The sentiment is just so bad. It is so negative on 3M that now is not the time for me, personally speaking, to sell. But I'll link to that video in the pinned comment below. And of course, I'm just speaking to my personal dividend investing journey, which gets me into my friendly disclaimer. Today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my personal journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. I am sharing it as I go, just sharing my personal journey here for fun and entertainment. Also, today's video, it's not tax advice. I'm not a licensed tax advisor. Again, just sharing my journey. I love you all. I'm going to see you in the comments below, and I'll see you in the next dividend stock investing video.